Hi there, welcome to Kneppyinvest. On the morning of 9th of July 2025, I read an article on Livewire website titled Four Stocks with Imminent Catalyst Backed by L1 Capital. Now, I'm not going to do an article reaction to this article and the four chosen companies, but I found a really intriguing comment made by James Hawken, the partner and head of the L1 Capital Catalyst Fund. A really intriguing comment that made my eyebrows raise and also made me think that possibly I have completely underrated a company that is listed in the United States. So what I'll do now is I'll briefly touch upon the four companies chosen in this particular article, and then I'll have a look at this particular comment from James Hawkins. So the four companies chosen that are approaching key inflection points: Santos, Horizon, Minres, and Qantas. Interesting four companies. Now, I would say all four of these companies would not be high quality. In fact, they're definitely in the low quality spectrum. Three of these companies are within the mining sector, and Qantas is a high capital expenditure company. And I would very rarely consider high capex companies to be high quality, but possibly they are good value right now. And if they are good value, possible hold over the next few years. But that is not the reason I'm recording this video. So if we go down, there is a little comment here in the main article that James Hawken offered an interesting take on why CBA's share price continues to power ahead and why the bank's valuation is flashing red. So I don't really care about why the share price of CBA is powering ahead, but what I did find really interesting is this particular quote. Offshore capital has rotated into large cap Australian equities, turning the ASX into a perceived safe haven. But Hawkins warned this is distorting fundamentals. And here comes a quote. CBA now trades on 30 times EPS, sort of implying that CBA is quite expensive. And I don't think we're going to see much argument about that. But it's in line with Nvidia, Microsoft, and Walmart. And as soon as I read those three companies, my first thought was, there's one company that does not belong, and that is Walmart. Nvidia, Microsoft, and Walmart. In fact, I probably would compare Walmart more to CBA than to Nvidia and Microsoft. And I was just really intrigued by the choosing of Walmart in this example. And then Hawkins goes on, and CBA trades on twice the multiple of the best bank in the world, JP Morgan. And I will be honest, if I had a choice between JP Morgan and CBA, I would choose JP Morgan every single day of the week, including Saturday and Sunday. But I want to go back to Nvidia, Microsoft, and Walmart. Now, I've always considered Walmart to be sort of on the lower end of the quality spectrum, high quality spectrum. I would consider Walmart to be a fairly mature company with not much growth prospects, particularly United States. Now, I don't know Walmart back to front. I do like the company. I do like the stores. I would definitely prefer Walmart over, say, Woolworths and Coles. Sort of like, if you've never been to Walmart, it's sort of like a cross between Woolworths, Coles, and, say, Big W or Kmart, that sort of thing. They sell everything. But if you go to any small town in any big town, even a tiny town in the United States, there is going to be a Walmart more than likely. So I do think they've hit saturation, but are they expanding overseas? Are they offering new services, that sort of thing? I don't know. But I've always thought of Walmart as being a fairly mature company with not much growth. So really intrigued to see why or understand why Walmart has been sort of put into the same basket as Nvidia and Microsoft. So what I'm going to do now is I'm going to go to Fiscal AI and I'm going to see if I'm completely wrong when it comes to Walmart. And I'm going into this completely blind. I haven't done this. A lot of times when I do these sort of videos, I'll have a look before I start recording. I have not done that today. So let's go to Fiscal AI and put in Walmart. And I'll be honest with you, I have not looked at Walmart at all in the past. I've had this bias. And I think it's very smart, very wise to always, maybe not always, but to on occasion test your biases, to see your assumptions, to see if they are right. Critical thinking is quite important. Okay, just take information just to see if you are right. I could be completely wrong. That'd be awesome. Anyway, so let's have a look at Walmart. It's listed on the New York Stock Exchange. Markup is $774 billion. Wowzers. There you go. This is a big company. And the Walmart people, I'm pretty sure they're out of Arkansas or something like that. They're pretty rich as well. Okay. Well, what I might do is just increase the font size here. Okay, so whenever I first started recording or researching, not recording, but researching a company, I always look at revenue growth. That's the first thing I always look at. Now, I haven't looked at it yet. I would assume Walmart has a growth in revenue of maybe 5% per year. Maybe if they're doing okay, 6 or 7. So let's see how right I am. And also mention earnings per share growth. Would it be surprising if earnings have been growing at a quicker rate than growth? Maybe they're doing share buybacks. Maybe margins have improved a little bit, but I wouldn't expect any sort of significant growth in earnings per share over the last 5-10 years. So let's see how wrong I am. Okay, so growth or revenue growth is exactly where I thought it would be. Now, over the last 10 years, 3.5%, but we have seen a little bit of acceleration in growth over the last 5 and 3 years. Okay, that could be because of inflation. Simple as that. Now, inflation has increased. They've raised their prices, which revenue has gone up. So you do have to take that into account. But 10-year revenue growth of 3.5% is probably exactly where I thought it would be. Yeah, so my assumptions haven't been challenged just yet. Now, earnings per share growth over the last 10 years, 3.5% per year. Now, they have increased 14.7% over the last 3 years, so that's interesting that earnings have been accelerating at a greater rate than revenue. But again, that could be because of share buybacks or improving margins, that sort of thing. Anyway, so nothing shocking here when it comes to the growth of Walmart. And honestly, if inflation goes back down to like 2%, 1%, I think growth in revenue and earnings will go back down to 3.5%. So really not the sort of company that you should put in the same bin just based off growth to Nvidia and Microsoft. In fact, if you have a look at Nvidia, this is going to be really unfair. I'm sorry, Walmart, but I'm going to just show you Nvidia, the growth in Nvidia over the same time period. And it's just completely different companies. Look at this growth in Nvidia. So over the last 10 years, revenue 41.2% and earnings at 60.1%. Even Microsoft, it's a little bit lower than Nvidia, but yeah, it's just why would you put Walmart in the same category as Nvidia and Microsoft? Okay, so let's keep on going. Let's have a look at the margins. Okay, before we have a look at the margins, I would expect operating margins to be fairly low, maybe a little bit higher than supermarkets here. I'm going to say 5% and have no idea about gross margins. So let's have a look. So gross margins are 24.9%, operating margins are 4.3%. So yeah, so maybe I was being a little bit too kind to Walmart when it comes to operating margins. When it comes to gross margins, I sometimes have no idea, but operating margins for these type of companies tend to be very low, and 4.3% is really low. High turnover company, so that's how they get a lot of profit, just turning over a lot of stuff, continually turning over. And I'd say the vast majority of Americans go into Walmart maybe once a week. I don't know. Okay, return equity is 16.4%, return invested capital 10.7%. I didn't have any expectations when it comes to those two. That seems fair enough. So if you just want to judge this company on return on equity or return invested capital, you might say, yeah, Walmart is a high quality company, but fairly mature. Dividend yield 1%. Pretty crap, by the way. Payout ratio 36.6%. I probably would have expected that to be a little bit higher. And even the dividend per share growth has been quite stagnant or quite low, 2.9% over the last 10 years. So you're not getting much of an increase in the dividend. And dividend yield is quite pathetic. In fact, I'd say it's quite pathetic for this type of company. So you're really wanting some capital growth. And I think you've received that over the last few years because the P ratio of Walmart is 42.5. Now, the expectations are for pretty good growth because the forward-looking P ratio is 37.2. So the analysis are expecting some fairly good growth. Now, if you have a look at the return of Walmart, we go to the return. You've actually done fairly well. But, so over the last 5 years, 19.7%. And over the last 10 years, 14.5%. So I would expect if you bought some Walmart right now, you'd probably more than likely underperform the market because the share price has taken off over the last few years, unless they do prove that for some reason, I don't know, they are increasing their revenue and their profit at a greater rate than what we've seen over the last 5 or 10 years. Okay, now, P ratio, 42.5. What I usually do now is I just like to see pretty pictures. Well, I don't think you could call this pretty pictures. So we do see a nice continual growth in revenue. It's increasing. That's probably what you would expect. You want to see these companies at least growing the same rate as inflation. That's fine enough. Operating margins, I just want to see how operating margins are going. So fairly stagnant, not much movement in operating margins, which is to be expected, to be honest with you. So we wouldn't expect to see much difference in the growth of income versus revenue. And we can have a look at that. So let's have a look at that. In fact, we didn't. When we looked at the last 10 years, they were almost exactly the same revenue and income growth. The other thing I want to look at is if they're doing any sort of share buybacks. And we do see the shares on issue actually decreasing over the last 10 years from 9.6 billion to 8 billion. So it looks like that they are or have been doing share buybacks. Now, the other thing I want to look at is now just valuation. 42 seems to be really high for Walmart, for this company that I don't think would grow all that much. In fact, is the P ratio of Walmart higher now than Nvidia? Might be close, which is weird. Okay, so let's have a look at the P or the typical P ratio for this company. I can see if we go back to 2016-17, we do see fairly low numbers, the sort of numbers I would expect. Okay, so let's have a look at the P ratio, and we'll get rid of the other ones here. And yeah, you can see these spikes, and that's one of the problems with P ratio, because a lot of times the companies will have one-offs which can distort their earnings. So always look at these sort of graphs with a grain of salt. But back in 2016, the P ratio of this company was like 15. That is actually what I would think the P ratio of this company should be. Now it's over 40, which is unusual. Another thing I'm going to look at is we can also have a look at. We'll have a look at free cash flow yield, and we'll also have a look at EV to free cash flow and EV to EBIT. And then we can actually make them invisible when I want to. And you can also see a bit of a spike here. I'll but I'll just decrease the. So which one is that? That is EV to free cash flow. You can see this massive spike. So there's probably 1 year where this company had fairly low free cash flow for some reason. But let's just focus on the free cash flow yield, which should be distorted as well, by the way, because of that one down period. But you can see over the last 10 years, the free cash flow yield of Walmart has been decreasing. In fact, back in 2016 and 17, when the P ratio was at a good level, the free cash flow yield was about 10%. Now it's 1.7%. So that's suggesting that maybe there's a little bit of froth. I wouldn't say a bubble, but you more than likely won't get much return moving forward out of Walmart. And let's have a look at the EV to EBIT. And yeah, this one has been rising through time. In fact, this is probably the best looking one. In fact, if you go back to 2016, the EV to EBIT was 10.9. Now it's 28.47. So definitely this company has seen an extended period of multiple expansion. So the market is more and more willing to pay a premium for the company, even though they haven't really shown any significant growth in revenue or earnings, apart from maybe a little bit of inflation helping their cause. Anyway, so my assumptions when it comes to Walmart haven't changed. This is, I think, a highly mature company. Now, even though I don't know if they have any expansion plans or if they are buying any companies to move into other fields, that sort of thing, what I see here is a fairly mature company, not growing all that much, but is priced as if it is a highly growing company. So something will have to give eventually. Either they're going to have to start growing really quickly, their revenue and their profit, or the share price will pull back a fair bit, mean reversion, that sort of thing. Now onto the chart. Now, sometimes you can just call a company high quality or not just by looking at the chart. And I'm going to do the same thing with Walmart right now. And I assume this will have the characteristics of a high quality company. If you go all the way back, so over time, if you just maintain a holding in Walmart, you've probably done fairly well, particularly if you bought below the 200-week moving average, which probably would be the time to buy these sort of companies when there is a bit of value and the company might be cheap. And the last time, actually, that's the daily chart. We'll have a look at the weekly chart. And if you go back, there was a long period from 1999 through to 2012 when this company just went sideways. The share price went sideways. I imagine back in the tech bubble, this company was significantly overvalued. I'd love to see the PE ratio of Walmart back then. It wouldn't be surprised if the PE ratio was maybe 40. And then because the company wasn't growing all that much, for 13 years, the share price just went sideways. So the valuation could catch up. So the PE ratio during that period was actually dropping, even though the company was growing at a small rate. So you can see what happens when companies do become overvalued, or what could happen when companies become overvalued, particularly these sort of companies. You can see the share price just go sideways, consolidate for a long period of time. So ideally, you want to buy this company when the share price is near or below the 200-week moving average. It has happened twice in the past 15 years. Yep, that was back in November 2015, that sort of period. And during the COVID-19, no, May 2022. It fell briefly, June 2022, briefly below the 200-week moving average then. Share price was $40. Share price has gone from $40 to $100 since then. And the share price right now is well above, significantly above the 200-week moving average. And you can see the share price is going on a massive run. Anyway, so really, none of my assumptions, none of my biases have been challenged in this particular video. Looking at Walmart, I don't think this is a high growth company at all. Nowhere near. No way should it be compared or put in the same sentence as Nvidia and Microsoft. I think Walmart is completely different than those two companies. And right now, Walmart does seem to be a little bit overvalued. And again, maybe we'll see the share price go sideways for the next 13 years. Anyway, that's all I have for this particular video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.